Stocks trade ranged as a marginally higher US CPI print muddles the interest rate trajectory. Auto and realty eke out some gains while FMCG and utilities drag. It's the mid-caps that outperform.
Siemens pips expectations on profitability and order flow, while Torrent Power sees prospects improve across segments. Even NMDC and ONGC manage steady quarters.
Apollo Hospitals' profit dips, but the company says Apollo HealthCo losses have peaked. Biocon reports a loss on acquisition costs, but biosimilars see strong growth. PI Industries misses sales estimates, but strong exports and margins cheer.
Air India inks agreements with Airbus and Boeing for 470 planes, 250 and 220 respectively, in the airline's first order for new aircraft since 2005. US President Biden and UK Prime Minister Sunak both laud the deals.
Well, hello and welcome to Halftime Report. I'm Sonia, and with me are Ekta Batra and Mangala Malu. Well, things are very quiet for the market today, just consolidating around that 17,900 level. There is a lot of action in mid-cap stocks, I must say that. But for the index itself, after a weak start, the market has seen the dips getting bought, but not conclusively, you'd have to say. Still down almost about 7-8 odd points. Auto stocks are doing well, with Eicher Motors as your big gainer post the numbers yesterday. On the flip side, though, you have ITC, ONGC, Britannia. In general, consumption is on the downside. ITC, Britannia, HUL are not doing that great. But all in all, you'd have to say pretty range-bound, very quiet morning so far. Let's see how the second half pans out.
Hi Mangalam. Hi Sonia. Yes, absolutely. You know, there was no real big surprise which came in from the US Jan CPI data. So that was definitely a positive. We have the Q3 FY23 numbers which have finally come to an end. So there is less amount of news flow incrementally that we are working with. So the markets are just about consolidating. An important cue to watch out for is whether or not the FIIs are actually buying the Indian market. We've seen 3 consecutive sessions of the FIIs putting in money, but let's see whether that sustains or not, or whether this is the flash in the pan. So that would be an important cue to watch. As of now, it's a quiet day.
It is a quiet day, so let's get chatting about individual stocks and individual results. Even if it is the last day, we do have a lot of numbers and a lot of reactions coming in as well. Lemon Tree Hotels, as all the hotel companies this time around reported a very strong set of third quarter numbers, over 62% rise in their revenue, and the EBITDA almost doubled year on year. The occupancy level was closer to 68%, and it did witness 77% occupancy in the month of December. Patanjali Keswani, who's the chairman and managing director of the company, joins us now. Thanks a lot, Mr. Keswani, for joining in. You have been pointing out that, you know, you are expecting 800 crores of revenues this year with at least 50% sort of margins. You've done that, you're on track to do that. Just wanted to understand the occupancy in the first quarter of this calendar year so far. How has it sustained from December? And are average room rates still, sustaining at higher levels?
So, Mangalam, it's if you look at the last quarter, the quarter of the start of the quarter was obviously at a very low occupancy because you had Diwali and Dussehra, and people don't generally travel for business during that period. So the occupancy to look at, the average occupancy to look at would be November and December, which is about 75%. And Q4 will be at least that much, if not better. As far as pricing goes, we are, the price change that occurred in our business was in October. So the price too in Q4 will be, the average rate of the room will be roughly the same, in fact, slightly better than Q3.
So on occupancy, you're saying, on occupancy you said 75%, but December occupancy was almost at around 77%.
Well,
so you don't think you can do better than that?
No, we can do better than that. I think in February we will do better than that, but don't look at 1 month. We are reporting a quarter's period. So the average for the quarter, excluding Diwali, was 75%, and I'm saying we would do the same. Now, it could be that in February we will do 80%. As a matter of fact, we are doing 80% in February. But traditionally, the beginning of the year, which is January, early part, and end of the financial year, which is March, the last 2 weeks, are lower in occupancy. So don't look at just 1 month, look at the whole quarter. And that will be 75%-ish.
Okay, all right. So you're already doing a peak of around 80 odd percent. Do you think that you can do better than that? Maybe because business travel picks up. And what would that do to your margins? Because what stood out to me is that your margins are over 50%. It's the highest in 15 quarters. Say, your occupancy does trend at the levels that you've spoken of. Where do your margins stand?
See, if, I had given some, I don't like to, give a guidance, but I had given guidance because it was the start of the year, start of a first non-COVID year, which was this year. So I had said we would do double the revenue of the previous year, which had the impact of COVID, and we would do a net margin, a net EBITDA of over 50%, which we are certainly going to exceed. But is this sustainable? Very much so at the current pricing level and the current cost structure. But my view is, again, the hotel industry is a little commodity-like. So right now you're going very clearly towards the top of the cycle. And if that continues, then every year, you will see an increase in occupancy, an increase in pricing, and an increase in margins. And for next year, I could say that our margins will certainly be well north of 50%. Our revenue will be probably, closer to 1,000 crores or more. So you can, you just have to continue on this cycle and the pricing for the next 3 or 4 years, and you can do a fairly easy projection of what will happen.
Right. It's interesting that you say that you're closer to the top end of the cycle for the hotel industry. You are targeting northwards of 1,000 crores in revenues next year with upwards of 50% margins as well. Just wanted to understand, closer to 850 is where your average room rate is, blended across all the brands, etc. For the industry as a whole, how much more room do you see for price increases? What I'm trying to understand is how much closer to the top are we when it comes to prices? Is it 10%, 15%? At what point does it stabilize and start to hurt demand?
So let me answer this with an analogy. If you look at oil pricing, for example, if there is a very slight increase in demand or a very small drop in demand, the price changes by 10, 15, 20%. So, you have in the last 2 years pricing at, I don't know, from $50 to $120 a barrel. The hotel industry is identical. An increase in occupancy, an increase in demand without an increase in supply means the prices will go up disproportionately, and the reverse is also true. So to answer your point, in 2007, our average rate in Lemon Tree was north of 8,000 rupees. And if it is 6,000, and it was doing 80% occupancy. So this is pure demand supply. And how much can the market bear it? Well, it is the market that determines the pricing, not me. So the question should be, how much demand do you see? And from that, the price will follow. So the demand I am seeing is a 15% growth every year.
Okay, 15% growth. One final question, because the luxury market is picking up so much, you have your Aurika properties as well, and some of them are stunning, but you have a Mumbai property coming up too. Can you tell us what is the, when will it open, and what is the kind of revenues that you're expecting? What's the pipeline for Aurika properties?
So, Sonia, let me go back for a minute. We have a Lemon Tree hotel, a Lemon Tree Premier in Bombay, very close to the Aurika. It's a 300-room hotel. Currently, it does north of 9,000 rupees ARR and about 90% occupancy. So if this continues, then this very hotel, that is the Lemon Tree Premier, will do 10,000 next year and 90%. Aurika is typically 35% higher. So we will open the Aurika, my expectation is, fully open it before November. Somewhere in October, we will open the hotel. It is 670 rooms. And it will take us 2 or 3 months to stabilize it, not more, because Bombay is a phenomenal market. So my expectation is this year will be an opening period. Next year, the hotel will do about 14,000 ARR, and well, the occupancy should be north of 70%.
Okay, sounding extremely bullish. So we'll get back and discuss more details and maybe the impact of the wedding season as well. But thank you very much for joining in and speaking with us. So that's Lemon Tree Hotels. Good occupancy this quarter. They have done very well in terms of margins as well as revenue. So there's a complete bounce back that has come in for Lemon Tree Hotels on the business on a year-on-year basis. We'll take a short break. On the other side, we'll be talking to Rajesh Bhatia of Uflex to discuss their Q3 numbers. Stay tuned.
Welcome back. It was a weak set of earnings for Uflex in this quarter. The company reported a loss of 85 crores, but that's because of currency devaluation in Egypt. Their revenue was flat year on year, while the margin saw a contraction. Let's find out more. Rajesh Bhatia, the Group President, Finance and Accounts and CFO at Uflex, joins us now. Mr. Bhatia, good morning and thanks for joining in. This time, of course, there has been this currency devaluation in Egypt, and that has hit a lot of companies that have an exposure there. But tell us, do you think this could continue in Q4 as well, the losses that you've seen? And was it only because of a forex loss, or are you seeing your, operational performance overall weaken? What is the situation now on the ground?
I think even in this quarter, we've seen in January also, the Egyptian pound has devalued against the dollar. And with the dollar strength, a lot of countries where we are present, we're seeing that the dollar availability is an issue, thereby, the currencies are devaluing, whether it is, Egypt, or it is Nigeria. So I think, but more or less it looks like, this quarter will be the peak of it, and then, it will be better. Even, on an operational side also, there is some impact, and, the life is getting back to the normal as we see that pre-COVID, this quarter was always the slowest one. So I think that those realizations are now sinking in. We had 2 very good years for in the COVID, but that is the normalcy is now catching up now, and
Sure.
India business remains very robust, as you would have seen that even in this quarter we seen volume growth, value growth, profitability is good. It's only that, this time we had an unprecedented, exchange fluctuation and devaluation loss of about 236 crore in aggregate, out of which 84 crore is from a formal Egyptian pound devaluation, and the rest of it also, we operate in various countries, we have various currencies exposure. So all that has hit us very badly in this quarter.
Mr. Bhatia?
Yeah.
We understand that, you have actually been hit very badly this entire quarter because of the devaluation, especially in Egypt. But like you mentioned, the oasis of calm for you all really has been the India business this quarter. You have done well in terms of volume as well as value growth. But do you expect those levels to sustain? And are you changing your focus to probably concentrate a little more on India?
No, I don't think so. There's any change in our plans currently. I think this dollar strength is now waning off, and we'll see as the US Fed tapers down its aggressive fiscal policies. I think the worst is behind us. All the jurisdictions we are in, I think once we have that sanity, I think we going to do good. India, again, we've done pretty well in all the parameters, whether it is the flexible packaging, even the packaging films and aseptic, as we've been saying that, that has been our superstar for the few quarters now. And just to let you know that January was a record production and the sales for us, creating another benchmark in our aseptic packaging as well as the flexible packaging division. So this business continues to do well. Overseas, we had certain issues because of the Ukraine war also, because the consumption in the European territory has been affected.
Right. Mr. Bhatia, we get that. So, just before we let you go, quickly, just some numbers for bookkeeping, if you could give us a sense. You had a 15,000 crore revenue target for this year with 16% margins. Do you hold on to that? What's your projection for next year? And on aseptic packaging itself, what's your volume guidance for this year and the next year?
I think let's talk about next year because that's relevant. So starting from January, I think we're looking now, and we've done that in January. We've done about 750 billion packs, which is equivalent to about 9 billion packs a year, as against our rated capacity of 7 billion packs. What we've announced. So I think that's a silver lining, and I guided earlier that that's one area where we're focusing very heavily and we debottlenecking our plants. So that has now shown sort of tremendous improvement. So I think that's one business where we continue to be very upbeat. On a margin guidance, I think if we take out the exchange fluctuation, I think our margins for the 9-month period is about 14.5%. Q4 holds the keys insofar as offshore business is concerned and how that pans out. We hit by about 1.5% because of the devaluation of the currency losses. And so if we put that behind, we are at 14.5 versus the guidance of between 16 to 18. I think it will be tough for this fiscal to maintain come back to 16. Let's hope that, on an overall basis, we are able to achieve that. And next H2 onwards, we will definitely see an improvement in European and US operations.
Okay, all the best. Thank you for joining in and giving us a quick comment on that. So domestic demand is good, but it is the challenging situation in Egypt which has hit their business quite a bit, the currency devaluation over there. That's Uflex down almost 5.5%. Let's slip into a quick break. When we come back, we'll get talking about the technicals of the market. Very, very quiet day, but Aditya Agarwala will be joining in with some trading strategies. Stay tuned.
Welcome back. Let's get a perspective on what's taking place in the F&O space. From a Nifty and Nifty Bank standpoint, we are consolidating between the 20 and the 100-day moving averages for the Nifty. Nifty conquered the 20-day moving average yesterday, 17,864, but it's still below the 100-day moving average of 17,947. And similar is the case for the Nifty Bank as well. The 20-day moving average for the Nifty Bank has been 41,562. And if you just take a look at the 100-day moving average for the Nifty Bank, 41,648 is where it is facing some sort of resistance. So important to see whether it breaks out of this range or not. But the fact that we've done well from yesterday and held on to those gains has given some strength and confidence to the 17,900 put writers. They've written almost 80 lakh shares for a premium of 40 odd rupees, telling you 17,850 to 860, which is the 20-day moving average, would see some sort of support. At the same time, however, we are seeing writing at the 17,900 and the 18,000 calls as well. In fact, those who are looking to write the 17,900 put and call, the straddle that is, they're playing for a range of 100 odd points, which is telling you that 17,800 to 18,000 is where the range on the frontline index is. Does that tie in with the technicals as well? We have Aditya Agarwala to tell us some more about that. Aditya, your thoughts on the index and individual stocks?
Afternoon and afternoon to the entire panel. Markets are consolidating, there's no doubt about that. But the best part is the range has shifted higher. From 17,600 to 17,800 on the downside to now 18,000 on the upside to about 17,800 on the downside. And my sense is it's a matter of time before Nifty actually breaks out of this resistance of 18,000 on the upside, which has been acting as a major hurdle. Once it does so, maybe Nifty should head to levels of 18,200 to about 18,250 on the upside. Given the fact that the undertone is strong, broader markets are seeing good action, there's stock-specific activity in the markets which is going on. On the Nifty, I believe there will be a breakout soon, maybe today or tomorrow. Traders should look for long opportunities, maybe closer to about 17,800 also they can look to initiate fresh longs, or at current levels also initiate fresh longs and wait for a breakout above 18,000. Then you can add on to the long positions, and the targets would be between 18,200 to about 18,250 on the upside. Bank Nifty, as you said, is a bit of a overhang at the moment, and 41,700 to about 750 is the major hurdle on the Bank Nifty. Once it crosses that, then there will be a smooth up move in the Bank Nifty as well, at least the levels of 42,000, which I see. So both Nifty and Bank Nifty, I believe, should see higher levels. Nifty predominantly should lead the charge.
Okay, just a couple of chart checks. Torrent Power, Eicher Motors, stocks that are reacting to their earnings. Any thoughts here and anything else that you like?
Eicher Motors, Sonia, definitely stands out. Look at the volume in this stock today after a good set of numbers. And this is one stock which went into a consolidation post a correction, post that sharp rally. So I believe Eicher Motors definitely stands out. At current levels, traders can definitely look at initiating fresh longs despite the fact that it's up 4%. With a stop loss closer to about 3,200, I believe stock has legs on the upside, at least the levels of 3,700, 3,800. Torrent Power, I would avoid getting into the stock because there's a huge gap. I believe stock can come down for some sort of a gap, filling up the gap. A couple of stock recommendations, yes. Again, on the two-wheeler space, TVS Motor is something which is looking very attractive on the charts. It's broken out from a downward sloping channel and continues to make higher highs, higher lows. So on the upside, stock can test levels of 1170 with a stop loss at 1070. On the downside, one should initiate fresh long positions. The second stock is ABB. Stock is just charging ahead in trade today. And this is again one of those stocks which had outperformed, went into a consolidation, and it's broken out of that consolidation today on good volumes. So on the upside, 3,400 will be the target. On the downside, 3,070 will be a stop loss.
Okay, all right, Aditya, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's on the technicals. Torrent Power, indeed, a very strong set of numbers. Net profit was up around 86% year on year. There was an interim dividend which they declared, which included a special dividend of 13 rupees as well. But let's move on. Biocon has been in focus on the back of their Q3 earnings, which were above street expectations, and the integration of Viatris's biosimilar business, which aided the company, though it was only for around a month. Though there was a net loss on account of an exceptional on account of the acquisition cost of around 271 odd crores. I did catch up with Kiran Mazumdar-Shaw, the executive chairperson of Biocon and Biocon Biologics, to discuss their Q3 performance, and began by asking about the recent stake sale in Syngene. Listen in.
Monetizing a valuable asset like Syngene is a very important way of creating value for building another business. And therefore, we felt that, retiring the mezzanine funding was very important. And we therefore felt that an effective way of using smart capital is to basically divest a small shareholding in Syngene whilst basically retaining majority control. So I think the Syngene stake sale will be used to retiring net debt. And we believe that we are also in the process of raising equity to look at the overall reduction in acquisition debt at BDL level. So I think that's the way we basically approached it. So,
Okay.
The combination of the Kotak fundraise that we've done now, which is a structured, fund, together with the contribution from the stake sale from Syngene will help us to quickly retire the mezzanine round, as well as, of course, we will raise equity funding to look at reducing the debt levels in BDL.
Okay, so I'm assuming that the mezzanine funding is now fully refinanced. You are looking for further PE funding in Biocon Biologics. You all have indicated that you all are in talks as of now. Can you provide more details? How much are you looking to raise? What would the dilution be?
Well, right now we have raised a $1.2 billion debt in to make this acquisition. And if you add the $300 million of existing debt in Biocon Biologics, we have an overall debt of $1.5 billion. So obviously, we would like to take it, to a level sub-$1 billion. In fact, ideally, we would like to be half of the $1.5 billion in terms of debt.
Okay. You've also taken additional funding recently from Serum. How much does Serum hold as a whole now, and would they probably look to put in more funds?
So right now, Serum has invested $150 million in Biocon Biologics, and of course, they've also given a loan for funding this transaction to Biocon of another $150 million. There is a possibility that they might convert that loan into equity at some stage.
Okay, all right. What is the status of Serum and Biocon's tie-up when it comes to vaccines as well? There were peak sales of around $300 million that was anticipated. But COVID-19 has now tapered off in terms of a vaccine requirement. So where do things stand?
So right now, of course, the deal that we struck with Serum Institute is not COVID vaccine related. And I think the overall deal structure relates to a revenue contribution or a top line contribution of vaccine sales to the extent of $300 million and a guaranteed EBITDA of about $110 million. So I think that's the way the deal is structured. And as I said, it doesn't relate necessarily to COVID vaccines. And there is a demand for other kind of vaccines. And as you know, in recent times, Serum has brought to the market the HPV vaccine and many other vaccines that it is developing.
Okay, you have done very well in your biosimilar business. You have also added Viatris in terms of numbers. Around 1 month is integrated into this quarter's numbers. You have guided for around a $1 billion run rate, exit run rate for FY23. That's on biosimilars. But what about bevacizumab as well as insulin aspart? Can you give us an update with regards to the complete response letter or the queries from the US FDA? When do you expect it to be resolved by?
So, we've had a series of complete response letters from FDA for many of our recent filings. And I think we are now on top of them because we understand what FDA is looking for. They have accepted our CAPA plan in Malaysia for aspart. We expect them to, receive and accept our CAPA plan for Bangalore for bevacizumab. And I think we feel quite confident that we will be able to resolve these issues before too long. Obviously, the addition of aspart and beva sales to the US business is always going to augment our performance in the US. But having said that, we are already seeing an improvement in market share of our, trastuzumab, filgrastim, and Semglee, and the much-awaited adalimumab launch is obviously something that people will be looking to in FY24. If we get aspart and bevacizumab approvals in calendar year 2023, that will add to this business. Having said that, Europe has all 7 products approved. And we will be basically ensuring that we garner market share for all these products in Europe going forward.
All right, so that is some commentary coming in from Biocon post the numbers. With that, let's slip into a short break. On the other side, we'll put focus on a lot of stocks which are buzzing around. NMDC, Eicher Motors, top of mind. We'll talk about those and some more on the other side.
Welcome back. If you're wondering what's moving in the market, Eicher Motors is actually the top Nifty gainer this afternoon after its numbers yesterday. Now, a lot of brokerages are very bullish, so let's get going on that. First up, we have Jefferies, which has a target price of 42.50 on the stock, which is much above the current market price. They have a buy there. They say that the Q3 EBITDA has risen to a new high. It's a growth of 47%. The Royal Enfield volumes are very strong, up over 30%. And Eicher Motors is well on track to deliver the highest ever Royal Enfield volumes and the highest EPS in FY23. There are multiple tailwinds for Royal Enfield as well: two-wheeler demand recovery, industry premiumization, limited competition and low EV risks. So that's Jefferies for you. Nomura has upgraded the stock to a neutral, although their target price has been cut to 3264. They say competition is a key risk because you have the entry of Bajaj Triumph and Hero Harley, which is a key risk for FY24. In fact, Morgan Stanley talks about this competition as well. They have an equal weight with a target price of 35.53. They say that the company has definitely gained market share post the launch of the new Hunter 350cc. However, the margins and the market share are likely to peak in FY23 because Bajaj Triumph launches in 2023 and Hero Harley launches in 2024, and those are some big competitors for Eicher Motors in the year to come. Citi has put out a note. They have a buy with a target price of 4,400. They say that the margins were better than expected in both Royal Enfield and the Volvo Eicher commercial vehicle business. Demand outlook is positive and margins margins should see a further uptick because of falling raw material prices. And the new Super Meteor 650cc has also seen a very good demand and customer response and could further support profitability. So that's the brokerage view on Eicher Motors. But the other big mover is NMDC. It's trading in the green after reporting a steady set of Q3 numbers. Nigel is here with the details. Nigel.
Well, NMDC's numbers are more or less stable, but the street views, Q4 to be far better, and also there was a dividend sweetener. So let's run you through the first part. First, the revenue is more or less in line, margins a little bit better, and profitability as well did come in more or less in line with what we were working with. In terms of their volumes, they were still lower on a year-on-year basis on a high base. It came in lower by close to around 3%. However, in the past quarter, there was export duty as well that was levied, which is now not there. So the hope is in Q4, volumes will ramp up dramatically as steel production as well ramps up. The other factor is realizations. Well, they have been subpar for the past quarter or so. But remember, post that, we have seen big price increases coming from NMDC, which will reflect partly in the fourth quarter. That's Q4 FY23. In addition to that, they declared a dividend of close to around 3 rupees 75 paise, which the street likes. And the street is also building in another big dividend that is likely to come in the next month and a half or so. So put all these factors together, the numbers were in line, but the street is optimistic on the future prospects. Back to you.
Okay, all right, Nigel. Thanks very much for that. So that's on a couple of large caps. We've spoken about Eicher as well as NMDC, but one particular stock which deserves mention is Apollo Hospitals, which has now risen to be your top gain on the Nifty, surpassing Eicher Motors as well. So it's up around 4% at this point in time. And remember, this is despite an operating margin which actually came below estimates. It came in at around 11.9%. Street was anticipating around 12.5%. The reason why you're seeing the stock higher is because Sunita Reddy has told us in an interview earlier in the morning that the digital arm losses have probably peaked at this point in time. The EBIT losses were at 74 crores in this quarter. The net loss for the business was 99 crores for the entire digital arm. So it seems as though the street is taking cue from that and the confidence that they've shown in the GMV for that particular business. So that's the reason why you're seeing Apollo Hospitals gain to become the top gain on the Nifty at this point. Take a short break. On the other side, we'll focus on a couple of other stocks such as Supriya Life Sciences. It was a sheer disappointment. More details once we're back. Stay tuned. Welcome back. Well, one of the stocks that we are tracking is Supriya Life Sciences. That stock is down 4.5%. It's recovered from the day's low, but nonetheless, that stock has already lost around 20% on a year-to-date basis. And I'll get to the statistics in terms of how they've done from the IPO time. But before that, the disappointment today is definitely the numbers. The margins have been the lowest that they have reported since they listed in 2021. The company recorded a revenue decline of 10.2% on a year-on-year basis and a 6.3% Q-on-Q decline with a steep profit fall as well. So the margins came in at 13.3% versus 32.7% and a profit decline of over 70% year-on-year. Q-on-Q as well, revenue was down over 6% margins 13.3 versus 46% and a profit decline of over 40%. The margins have been extremely volatile for the company, and maybe the trend history will indicate how volatile the numbers have been, and the 13.3% margins that came in this quarter. To give you more perspective in terms of how the stock is done, it's down 20% year to date, but if you look at it, it's down 60% from its 52-week high of 515 odd rupees. It was a 700 crore IPO which was subscribed over 70 times in December 2021. It listed at a 55% premium in December 2021. The issue price was 274 rupees, and the stock, if you just compare it from that listing price of 425 rupees, it is halved and now currently at 188 odd rupees. So you can just give you an indication in terms of the volatility of the numbers and how the stock has performed as well. We need to take a short break on that note, but more on stocks as well as commodities once we're back. Stay tuned.
Welcome back, and joining us now on the show is Chirag Sheth from Metal Focus. Chirag, hi, good to have you. And it's been a constant decline in the gold prices, now trading at a new 5-week lows. We've seen 1850 give away as well, and we seem to be inching towards that 1840 mark right now. It clearly has been about the strength in US dollar, the hawkish Fed stance that the markets are reacting to right now. But where do you see support now coming in for gold?
So, Manisha, you are aware, we've been saying this for quite some time, that the rally that we saw in the market was actually unjustifiable. Fundamentals were supported and the market had to correct somehow. And then two things which really helped aside from the hawkish trade was the strong job numbers and the reduction slowdown in the pace of inflation going down. So that is now helped prices to correct a bit. We believe that prices are headed lower. We could actually see some $1,800 in the next couple of months' time.
Almost at 1840, where is that you see now support come in for the gold prices in the international markets?
So I think, look, 1840 is a bit of a crucial level because we've seen that over the past, 6-9 months, we've seen a bit of a resistance and we had come in at 1840 and big prices reached and moved higher. So I think this is the current crucial level. If market continues to hold below this level over the next couple of weeks' time, then liquidations would actually start picking up pace, and then we could see a bit of support coming in at $1,800. However, taking a long-term view, we still believe that prices are headed lower.
Okay. Well, we have seen a very sharp decline already come in for the gold prices. 1960 was a high already for 2023, and from those kind of levels, we are now closing clue 1840 on your screens, as you can see. And as Chirag tells us, that if 1840 breaks, then 1800 and even below the kind of levels is what we can see in case of gold. But not just gold, take a look at the silver prices, and we have seen sharp declines onto that one. It's trading at a 3-month lows for silver. Platinum prices are trading at a 3-month lows. You have palladium, which is trading at a 13-month lows right now. The last time you saw palladium prices at these levels were in December 2021. The reason that you have seen palladium decline is because, one, the inventories are increasing, and because the palladium prices ran up so much, the markets have moved on to platinum as a proxy of usage in case of EVs and smartphones, etc. That is what we've done in the last 1 month in case of many of these precious metal prices. You have gold prices down 4%, silver is down 11%, platinum 13%, and palladium as well down 15%. Chirag, it's not just gold. Across PGMs, precious metals have seen a constant decline the last 1 month, now trading in negative.
Yeah, no, that is right, because a lot of precious metals, especially silver, platinum, palladium, they kind of followed gold. So now gold started correcting. You saw, the precious metals also correcting with similar ferocity. Look at what has happened in fact, silver prices. Silver has corrected also sharply. So we believe that, because all these precious metals kind of took the lead for gold, if gold will continue to correct, then we will see a much faster pace of correction in other precious metals.
Okay.
Okay, all right, Chirag, as well as Manisha, thanks very much for that. I'm sure there will be demand for those lower prices of precious metals on a month-to-date basis. Gold down around 4%, but platinum and the likes down over 10%. Well, with that, it's a wrap on Halftime Report. Stay tuned. Business Lunch up next.